Welcome to the Economic Rockstar Podcast with your host, Frank Conway, connecting brilliant minds in economics and finance.
Hello and welcome back to another episode of the Economic Rockstar Podcast. And if you're new to this, I hope you get a chance to catch up on the back catalogue that we have, over 130 episodes. And in this week's episode, I continue my conversation with Eric Lonergan. And if you enjoyed this episode and want to catch up on more, if you haven't heard it already, why not go back to episode 131, where you can listen in on our conversation where we talk about the philosophy of money and more. This episode is a little different. Eric took time out during his busy schedule and had the interview in a coffee shop, so there's noise from a coffee shop in the background, and to some that is actually quite relaxing and soothing. And I hope it comes across like that in this episode and doesn't put anyone off. So whether you're at home or at work, why not put on a brew and kick back and listen to this conversation. And when you get a moment, I'd appreciate if you could leave an honest rating or review on iTunes, which will help the show move higher in the rankings and will also get more listeners as a result. And don't forget to check out my Patreon page at patreon.com/economic rockstar, where you can find out how you can support the show or even sponsor the show, and in return I'll give you a personal shout out on the next episode. And during this interview with Eric, we mentioned Nobel laureate Professor Harry Markowitz, most famous for his portfolio theory, and I will be interviewing Harry Markowitz in the next couple of weeks. And if this is something you'd like to have your name associated with in an episode, please visit the Patreon page or send me a personal email and I will reserve that sponsorship spot for you, limited to 3 people. So enjoy this episode. I hope it goes well in terms of the background noise, but personally I think it has that intimate feel to it. And once again, thank you so much for listening and for always supporting the show in this way. So you were saying you were at a roundtable discussion with some colleagues there yesterday, and you were talking about events that are going around in the world.
Yeah, it was with I was there with a group of, there were some academics and some journalists and some colleagues, and yeah, just I guess thinking about the investment landscape, the kind of political economy and the challenges facing monetary policy. So very entertaining discussions, as you'd expect.
You mentioned earlier on that you were talking about money and how it actually related to your book.
Yeah, I think we spoke about this the last time, but the role of trade and money in conflict resolution, which I think is one of the dimensions of markets, which is ignored typically in economics, which talks about efficient allocation of things. Yeah. Whereas actually, if you look at the anthropological literature, trade played a very important role in conflict resolution. And I think you see this tension today in global political economy between there's a minority that are trying to motivate parts of the electorate by using tribal-based political motivation, but that's very inconsistent ultimately with markets and trade. And I think that's relevant to what's happening currently. So your kind of hope is that conflict between these more nationalistic countries, if you take, say, China and the United States as an example, your hope is that the high degree of interdependence as a result of trade and economic integration creates an incentive, to reduce conflict and limits the aggression. So it's that kind of tension and relevance in markets is very relevant today.
With the policies that Donald Trump seems to be following at the moment, which is to bring back investment into the United States, that interdependence could end up being more diminished.
Yeah, it's a very it's a very interesting state of affairs because there's obviously a very strong political dimension. Trump made a great deal of particularly within the Rust Belt of America. And in a lot of areas that traditionally there was very little Republican support, and he was able to motivate and swing significant minorities of the electorate to shift who would have been traditionally Democrat voters to vote for him in the presidential election. To some extent, to be honest, he's almost being true to his word. He's following through on that. How precisely it works out, is very unclear. One can make a legitimate case if one thinks certain trade activities are unfair. But typically, you'd prefer to go to international agreements and, follow international method in terms of getting dispute settlement. But I'd say it's too early really to tell what kind of long-term implications are. It's not the first time this sort of stuff has happened, particularly in industries like steel.
I don't know whether it's a conspiracy or something that I've been thinking about this a little bit more, but if you look at the way China and North Korea display their armed forces, it reminds me of the images that we'd see with Germany post-World War I with Adolf Hitler. And if there was a possibility of, and there is always a possibility, whether it's high or low, of conflict again between these kind of large countries, is it that the likes of China would be better because they have a lot of manufacturing facilities that they could easily change around and turn them into ammunition factories, whereas someone like the United States, who used to have the car manufacturers and so on, wouldn't have that at all? And by bringing back the industry then into China, it kind of allows them the possibility of being a bit more flexible and bringing back the likes of steel and working with steel, if need be.
I think, if one actually gets down to the kind of probability of serious conflict between countries in the world today, to the extent that one can say anything about it, there's probably three things that are relevant. The economic incentive not to engage in confrontation or violence is extremely high now between these countries, because they have very, very high levels of GDP per capita relative to where they, certainly even if you take the Chinese case, relative to where it was even 20 years ago, has made dramatic economic progress. And obviously the United States is a huge beneficiary, both through trade and financial transactions and activity in its integration with China. And it's, it remains the global leader in terms of global technology. So I think, the interests are huge. I mean, if you look at history, people tended to go to war because they perceived it to be in their interest to do so. It'd be very, very difficult to map that onto the world today. You might look at the case of, say, the Russians, which have probably been the most aggressive of major powers, and the kind of skirmishes that they've been engaging in. But then it's not clear that that's a regime entirely motivated by economic well-being. So it isn't an economic success story. I think it's less plausible to see a successful economy deciding to engage in aggression because it's got so much to lose. So I tend to be optimistic from that point of view. The other thing, of course, people point to is nuclear weapons as a deterrent. So the problem with kind of major conflict or a world war today is you have got kind of mutually assured destruction, which is a pretty significant incentive not to engage in it. And I guess the final thing is, I think there's a lot of international bodies now, methods. It's even interesting the way politics works, where I think, our political systems are reasonably functional, whereby if you start to do things that are really detrimental to the broader population, actually the political system does respond to it. So I think the world today looks very different, to kind of pre-war worlds in the past, would be my own relatively optimistic perspective on it.
In relation to your book, Money, Eric, I know we touched on it in our last conversation. We were talking about the philosophy of money, when you mentioned also earlier on, you alluded to interdependence, and it also controls the future and has a measurement and a lure too. And reading further on your book since I was last talking to you, there's a couple of economists that you mentioned there, and quite well known. And they touch on the whole idea of probability in terms of risk. Frank Knight, Hayek, and also Harry Markowitz. And they're coming from different understandings of how risk is measured and how we perceive risk. with Frank Knight, you mentioned that he perhaps got it somewhat wrong, and you were more favourable to Hayek in terms of him noticing that you can't measure human emotions, and therefore something that's immeasurable can lead perhaps to problems, and we need to sort those out.
Yeah, I think it's true. I mean, so Knight is kind of famous for this distinction between risk and uncertainty, where he says risk is measurable probabilities and uncertainty. You can't measure the probabilities. Well, I think one of the negative consequences of that is it stopped people from thinking more about what risk means. There's a distinction between a knowable probability and an unknowable probability, but I'm not actually sure that's the distinction between risk and uncertainty, as the words have meaning, in our language. So I actually think one of the consequences of Knight was to narrow the kind of formal use of risk, and particularly as it became used within finance, it became associated with standard deviations and trying to effectively measure probabilities. And I think there has been a kind of loss of understanding, particularly as we try to use more formal models within finance and more generally in terms of how we think about risk. So Knight makes this distinction between risk and uncertainty, where risk is kind of measurable probabilities, and uncertainty is where you can't measure the probability. Now, I think it's a fair distinction, but I'm not sure it's the distinction between risk and uncertainty. So the concept of risk is actually a much richer concept than what Knight presents. Knight's just contrasting known probabilities with unknown probabilities, but that isn't the end of what that shouldn't be the end of the discussion about risk. So I think there's still, if you look in the financial industry and you look more broadly, I think there are problems with the way we think about risk. And this is something that concerns me an awful lot within the financial system now, that there's an overwhelming emphasis on the use of volatility. Mm. Now, to many people listening may not know what volatility is or understand what volatility is. Effectively, volatility is just how much prices move by. So do they move by an awful lot, or is if they move an awful lot, they're deemed to be highly volatile. If they don't move very much, they have relatively low volatility. So you might think of, for example, if you put money in the bank as a deposit, the value of that in terms of your spending power from one day to the next doesn't move very much. That will have low volatility. Yeah. If you put your money in the stock market and it swings around by 2 or 3% a week, that's high volatility. Mm-hmm. And that has become the benchmark for risk. So then the financial system, regulators, investors, consultants, all of the intermediaries, banks, have decided that's how we should think about risk. And then they try to measure the probability in a kind of Knightian way. And then they talk to people about whether you're taking high risk or low risk. Now, to put this in context, to make it show how extremely problematic this is, if you look at, I should say it fosters very short-term thinking. Okay. Because also what's tended to happen is people focus on daily volatilities. So when you get statisticians and computers involved, people want more and more data. And one way to get data is to use higher frequencies. Yeah. So, which you should, but that's inconsistent with what we should be caring about. I mean, most people who are investing for the medium term. So they shouldn't be caring about what happens from one day to the next. But the risk models that the entire system is using is really based off daily volatilities. So it's actually encouraged myopia or short-termism. Yeah. And I think this is a very big problem now within the financial system.
When you have more data or more observations, there's a lot of noise built in, and especially when media might be reporting on this, it sensationalizes the whole idea that the markets are, for that particular moment, it seems quite worrying. And as you said, a lot of people are invested in the medium term and not the short term, which actually takes place more so by high frequency traders who enjoy looking at this data.
Well, if you think of it like this, let's say you're thinking about your pension, which might be in 20 or 30 years' time, you really don't care whether the stock market goes up or down tomorrow. You care what you're likely to get as a stock market return on a 20 or 30 year view. Yeah. Now, if you think if we look at through the lens of volatility says today that cash is safe, and it says the stock market is risky. But if I frame it differently, and I say to you, well, cash at the moment, if you're in the Eurozone, you're probably getting a negative or zero interest rate in your cash. And inflation is likely to be greater than 1.5%. And that means you're going to lose between 1.5% and 2% real after inflation every year.
Yeah.
Now, if you compound that over 10, 15 years, you're suddenly looking at 20 to 30% real declines in the value of your savings. That's a very odd view of a safe asset.
Yeah.
I would say that's a very risky asset because you have a very high probability of permanently losing your savings. Whereas by contrast, if you look at, say, the European stock market on a 20-year view, you've got a very high probability you make a positive return. In fact, it's priced to deliver you something like 6 or 7% after inflation.
Yes.
So you've got a very high probability of making quite a good return. So now, which is riskier? And that's a very interesting question, which I think, the Knightian framework and how financial theory has evolved hasn't helped us at all. Now, you mentioned Harry Markowitz.
I'd be interviewing Harry Markowitz. I got in touch with him, and he'd be coming on the podcast in a few weeks' time, maybe a month's time. And it'd be interesting to see, given that you actually mentioned in his book when he talks about distributions. I'd love to hear what you had to say about it and how you relate it to what we're talking about now, which is risk and the measurement of risk.
Well, it'd be very interesting for you to ask him about what frequency people should use. So the great insight of Markowitz is the idea that risk is associated with covariance. Now, again, what does that mean to most people? Well, what that means is when you when you deploy your savings, so when you invest your pension or your insurance policy, think of it, insurance is a very good illustration of this. You don't just care about your return. You care about when the return occurs. Right? So an insurance policy, in a sense, is an investment that gives you a return when you need it most. Right? So it has a negative correlation with some kind of bad outcome. So if it's, let's say you want to protect your family, you take out life assurance. Well, in a sense, what that does is that delivers you a return when something goes wrong. And Markowitz was emphasizing the point that you want to seek diversification, effectively negative correlation, or within your investments, which is a very wise and important point. The problem, in many ways, though, is how it's been done, and again, over what kind of time horizon. So it'd be very interesting again to ask him about this. Why should you care about daily correlations or monthly or weekly correlations? You should really, again, if you're thinking about your pension, probably think about very significant shifts in regimes. So you might care about an inflationary world, or you might care about a world where healthcare costs are very high. So what you're actually trying to protect yourself against is not correlations on a daily, weekly, or monthly basis, but is more very significant life outcomes or economic and political outcomes against which you want to protect yourself. So, for example, a lot of people would have taken Markowitz and said, well, that means I need to buy, 100 stocks in the stock market or 1,000 stocks to diversify myself. Well, that doesn't really significantly diversify you against very much, because you're still exposed to what happens to the stock market, whether or not there's a recession, what happens to profits, and whether the kind of political regime is favorable to the stock market or not. And those are probably more important things that people might want to diversify against.
And why did you give an example? Yeah, no, I wondered why you gave an example of you might want to look at a country that has high healthcare costs. Is that to diversify those higher expenses by investing in something else to offset it?
Well, I think one of the things that is one of the concerning dimensions of technology, or one of the unintended consequences of technology in most areas of our lives, technology is trying to make us more productive and kind of reduce costs. Whereas one of the challenges within healthcare, technology is contributing to increased cost because our life expectancy is being extended, and the treatments in various ways we can be treated. Now, all of which, of course, is at one level is great news. but it's a big increase in the burden of cost, which is, and this is a problem for the public provision of healthcare, because we all believe that, we're all born equally and we all have equal rights and access to healthcare. But obviously, if you keep on increasing the burden of cost through technology, that becomes a bigger and bigger burden on the public purse. So I think, that is something that concerns people when they're thinking about their retirement, and you have increased longevity and you may have increased healthcare costs. So when one's investing or thinking about those kinds of things, that is something that you would want to be insuring yourself against, or something protecting yourself against.
Eric, you're in the hedge fund industry, and we were trying to connect a call last week, and I think at the time you mentioned you messaged me saying that you're trying to get a portfolio trade together. I'd love to know, not what the portfolio trade was, but
sure,
I'd love to know what kind of assets or derivatives did you use, or what would you typically use on a daily basis as a hedge fund manager?
Well, so, in my kind of professional capacity, my day job, which isn't about the philosophy of money and these interesting subjects that I can discuss with you, but in terms of how I earn my living, I'm responsible for a macro hedge fund and some multi-asset funds. I guess it's important, by way of background, to think about what they actually are, because again, I think a lot of the jargon and a lot of the portrayal in the media is very confusing. As an investor like me, or as a fund manager, I'm the custodian really of people's savings. So the end investor is very often a charity or an endowment, maybe a university endowment. In our case, people's life insurance policies, and then of course the savings of the general public. So people who would save through various savings vehicles, which is a very, very broad range of people. So the people whose capital I'm looking after are actually a very, very broad range of institutions and individuals. And my job is to try and generate them a medium-term return without taking undue risks. So again, I'm trying to diversify against risk, and pretty much in all environments trying to protect and grow their capital. Now, it's an interesting in terms of philosophically how you can do that. And as you know, there's a big debate within finance theory about whether you should just index everything. You spoke to Eugene Farmer. So Eugene Farmer's recommendation would be, don't pay people like Eric to look after your savings. Just put it into the lowest cost, index tracker.
Yes,
and don't look at it, right? And so ETFs. So in a sense, exactly. Now, the challenge he might have is it's not totally clear which assets you should invest in. So I do asset allocation. So I'm very sympathetic to a lot of his ideas about reducing costs, and I think for an awful lot of people that makes an awful lot of sense. But obviously, given what I do, I think one can do better than that. And I also think it doesn't answer all of your problems. So people would say, well, how much should I have in property? Or how much should I have in bonds and fixed income? How much should I have cash in the bank? Should I invest in the stock market? Particularly if you're a charity or you're a university endowment who might have or a life insurance policyholder. So those have very, very different time horizons, maybe, and very different requirements that you have to think about. But essentially, when I look at markets, I view them as fundamental entities, but also psychological entities. And I think that the bit that we try to add value for our investors in is exploiting some of the behavioral and psychological biases. So largely when markets overreact or underreact to certain things, that's what creates opportunity. And again, what I found very interesting, we chatted about it last time, was this event that we had right at the beginning of this year, where arguably there was no news, but you had very, very significant moves in price, which I think were probably just driven by market participants. And they create opportunities for doing what I do. So I think I can deploy people's savings in a slightly contrarian fashion that will enhance their returns into the medium term. And the instruments I would use would be to minimize costs. So, again, there I have a lot of sympathy with the idea of absolutely trying to keep your costs down. So the kind of instruments there, for example, derivatives would be things like equity index futures. And I'll also use ETFs to transact.
You wouldn't use options or anything? There'd be more futures, would it, that you'd actually use?
You can do. The problem with options tend to have higher transaction costs.
Okay.
And, and very explicitly, the futures are probably the most efficient way of transacting. But it'll depend on the circumstance.
Yeah. Like, given futures are considered a zero-sum game, and if, I don't know if you do dynamic hedging, or given and comparing that to options, whereby the most you lose is your premium if things don't go your way. In circumstances like the possibility of a turnaround in the market, as you said, you're a contrarian, would you be able to apply something like options to your current portfolio, or was it mostly selling futures that you'd actually work toward?
Well, in the instance in February, I was buying futures because the futures prices had fallen very rapidly.
Okay.
And significantly. But you could do it using options. The problem is options at that point in time are very expensive because options priced off the volatility, and the volatility was high.
The history of money, we know, has taken many forms. And the fiat money that we have today is being challenged in a small way at the moment through cryptocurrencies. And recently, as we know, you can now trade cryptos or Bitcoin as futures contracts.
Oh, okay.
And this would be considered a volatile currency, given its high in dollars about almost 20,000 and now hitting about 7,500 today. And they are moving quite a bit, even though a number of years ago, 6 years ago, you probably would have got one Bitcoin for $1. What's your feeling on that, or how does it link into your philosophy of money?
Yeah, it's very interesting to me on multiple levels, both professionally and in terms of how I think about money, because all of these cryptocurrencies reveal something about the nature of money, which is that money actually doesn't have a present value of cash flows because it doesn't generate any cash flow. So, and its value doesn't reside in a real thing, so it isn't backed by anything. It's literally just a piece of paper or a digit on a computer in the case of Bitcoin or the electronic versions within the banking system of what we use as money. So people have struggled with this immensely because to many people, money is one of the most important things in their lives. And yet it appears that at another level have no value, which is a kind of curious starting point. And this goes back to, I think the closest analogy is to language. Language doesn't have a physical value, and yet language is incredibly valuable and important to us. So it's more like a tool. And the parallels between money and language are even deeper than that, which is we really use money not because it has not because it has physical value or some kind of, or a value in an alternate use. We use money because other people use it. Yeah. So the reason when I go to Ireland, I use euros is because everyone else is using euros. It's not because I think euros is the best currency. And that's an incredibly important thing about money, is you don't use something because it's the best money. You use it because more people use it. And that's a very unusual feature. And it's exactly the same with language. We don't speak English because it's the best language, which, as you know, is a debate in of itself in Ireland. But we use English because everybody else uses English. And because if you and I come up with our own language, we won't get very far. No. And it's exactly the same with money. And to be honest, that's why most of these cryptocurrencies, probably all of these cryptocurrencies, won't have any value. They may have some very interesting technology which will be taken up by an established money. So the technology will end up being co-opted probably by one of the existing monopolies, whether it's a Visa and a MasterCard in the payment system area, or whether it's the banks in terms of payments and clearing, or whether it's ultimately governments will actually use some of these technologies, to underpin our existing money system. So the problem they all have is creating a network. The fact of the matter is, it's very difficult to use Bitcoin, and not many people accept it as payment. And there's good reasons, why they don't and they're not going to, and in fact, the more volatile and speculative it is, the less likely it's going to be. So there's a kind of huge irony that in a way, the more the price goes up, the less valuable it's going to be. Professionally, it's very intriguing because it tells you also, it'd be a great question to put to Eugene Fama, or it'd be a great question to put to Harry Markowitz. is why are people bidding up the value of something that has no value? And you can only point to behavioral and psychological and social explanations. Bitcoin has become a social phenomenon. So people are absolutely buying it on the basis of a greater fool theory. Some people may believe it is actually going to change the world. They buy into the narrative because the price goes up and they become aware of it. There's a whole load of behavioral and social. A lot of people are involved because they've seen other people making money, or they've heard about other people making money, or their friends are involved in it, or their sister-in-law's doing it, or their brother-in-law. And people are very myopic. So, it's a bit like buying lottery tickets. So you have all of these behavioral, psychological causes with no real underlying, fundamental news. So what is causing that price to move from one day to the next? Because there's no news flow. It's a very interesting lesson in the behavioral and psychological properties of assets.
Yeah, and it's like we could point to certain variables or parameters as to why the likes of these currencies are moving, and obviously it's more people would like to access it and take a share of the crypto that has a scarcity, because there's only so many going to be mined. But then you have news coming out of some countries that they're banning these cryptocurrencies, and then the price reacts to that. I think it was some news coming out of Canada or South Korea, I should say, India
but currency,
as well. So.
The thing is, currency isn't scarce. There's no shortage of currency. So one has to be very careful here about things that we actually need that are scarce, and in the sense things that are superfluous that may be scarce. I mean, you and I could decide to issue, a couple of $1 million notes, the Conway Lonergan Bank, and they might be very scarce. So I don't think we'll get anyone to buy them.
No.
Unfortunately.
Although in England, they have some towns like Brighton have their own currencies, haven't they? For example, there's a Bowie note.
Key thing there, absolutely, yeah. But you have to have a network. If you've got an established communities, if you can get a community of people to accept it and agree to use it, you can establish money. But my point is that scarcity itself is no guarantor of value, because we don't have a shortage of money. In the sense, as an individual, I must say I'd quite like to have some money, but collectively, the way you measure too much money, too little money is if there was too little money, there'd be deflation. Right? If there's too much money, there'd be inflation. And we're in. You might argue that we could do with a bit more money. You could have some helicopter drops at the moment, maybe in Europe, get the inflation rate up. I'd probably advocate that. But in most people's minds, there's no shortage of money. So these idiosyncratic cryptocurrencies, I would say there's a high probability that most of them will disappear, if not all of them.
There's an interesting case study about money. I only realised this where I'm from, or where I'm living at the moment in Waterford. There's a town called Portlaw, and there's only a couple of thousand people there at the moment in its population. But about the time just prior to the Irish famine in the 1850s, a Quaker company came in called the Malcolmsons, and they were looking for a place to set up their cotton mill. And they had a couple of places in mind. One of them was Clonmel, but they decided to settle in Portlaw, where there was the population was only something like 300 people at the time. And they built one of these industrial towns. And Cadbury in the UK actually modelled the town on Portlaw, which was designed by the Malcolmsons, this Quaker family.
Interesting.
And it was one of the very few areas in Ireland that didn't suffer from the Irish famine, even though today or over the last 30 years or so, it seemed to have suffered from recessionary periods in the 1980s and so on. It flipped. But people didn't have the effect of the famine at the time. And there was actually a lot of net immigration. A lot of people from Leicester in England actually emigrated to Portlaw to work in this factory. And because this company wanted to look after the workers and the population, the people living in the town, they decided to print out their own money.
Interesting.
And it was nicknamed leather money, because they were also leather manufacturers, and it was made of cardboard, and they had the seal of the Malcolmsons, and people could use this money within a 25-mile radius of Portlaw, which included Waterford City and Clonmel, and there were shops that would actually take this in and use that as a means of transaction. They were paid in this money.
Very interesting.
Quite interesting, yeah. That the Malcolmsons actually betted on the wrong side of the American Civil War and lost out, and subsequently had to shut down.
Well, you see, what it teaches you, the key is to have a community of users. So you have to have a network of users. So it's not about the best technology. And again, it's very similar to language. It's very similar to issues of software, even to social media. And it's a mistake to think that the best technology is out there. And I think this is part of the narrative that fosters the speculative bubble in these cryptocurrencies. People get taken in by the technological innovation. So it's a mistake to, and I think this is partly behind the bubble in the cryptocurrencies, is this great innovation going on. So you can say, well, these are incredibly interesting technologies that are better technologies than what we've got. But it's an error to think that the successful money is the best technology. The successful money is the one with the strongest established network. So you can understand how a very big company with a great reputation in a town or in a region might be able to establish money because of the credibility it has. It's able to establish a network, and once the network is established, the money starts to have independent value. And this is the same feature. It's called a network externality. It's the same feature within languages. We know there are local languages, but they tend to pretty much stay local because language is ultimately more valuable the more people that speak it. And again, if you look at the history of language, it's not at all the most efficient language. People have tried to create very efficient and clever languages that will be much easier to speak and much easier to read and write. But the one that wins is the one with the biggest network.
I never thought of it that way, but it does make sense when you use languages to relate to how money is taken up and used, because Cambodia, if you visited Cambodia, they only really accept US dollars.
Yeah. Well,
and that's what everyone uses.
Well, that's the thing. I think to go back to the nationalism point and how money undermines nationalism. And this is one of the themes in the book, is the existence of global money, and it's very interesting how people can be very nationalistic, but they don't seem to be nationalistic when it comes to their finances. And money can embed an institution. And really what they're saying, when we use the money of another country, we're actually importing their institution. We're actually saying we trust their institutions more than our own. So if you go to somewhere like Argentina, where most of the significant transactions, I think it's still the case, but it has been the case for the last 30 years, most of the significant financial transactions are all done using dollars on mortgages and house purchases. And what that really tells you is the Argentines trust American institutions above their own. Now, right there is kind of undermining of tribal nationalistic beliefs, because we're willing to import someone else's institution and use it.
Eric, can I ask you a couple of quick-fire questions?
Of course.
I didn't get a chance to ask you the last time. If you were to be able to step into the DeLorean and time travel, what era would you like to go back to, and who would you like to meet?
Wow. It would have to be the Greeks. Definitely.
Oh,
I'd have to be there with Plato and Socrates and Aristotle. They spent all their time thinking. The opposite of big data. They had no data, and they managed to do so much thinking. They worked everything out.
And is there any particular speech that you'd like to sit in and listen to if you were, say, beside Plato?
I'm just trying to think. Well, you see, we had a symposium yesterday, which was what I organised. I think it would have to be probably Plato's symposium, but that isn't about money. That's about the complete opposite. The Plato symposium was about the god of love. So I'd quite like to sit in and listen to the Greeks opining on the nature of love.
Is there any particular theory in economics or finance that you feel shouldn't have its place in our discipline? that it's just kind of, it has no relevance, it doesn't make sense, it doesn't fit the world we live in today?
I mean, that's a good question for me because, as you know, I'm an eclectic, so I tend to think there's value in virtually all theories. Is there a theory that is absolutely wrong at all times? Nothing off the top of my head. Even something, efficient markets gets a very bad press, but I think it's relevant to certain points. Sometimes markets are efficient. My instinct tends to be the opposite. I think most of the theories that have survived through time tend to have their time and place. The mistake, the error that's repeated all the time is to misapply, is to think that some idea or theory in economics or finance is constantly true, whereas it's only true in certain circumstances. And I think we do make that error all the time, which is we look to the recent past, and what worked in the recent past, we then extrapolate and think it's going to be working now, and very often it's no longer working.
If you have a good book that you'd like to recommend, something you might have read recently that you'd like to share with us that we could, other than your own, of course.
Sure. Well, I've been reading, and I think they're unbelievable, are the lectures of Michel Foucault, which have been published, his lectures from the Collège de France. And Foucault, when he was giving his lectures, was standing room only. And I think French philosophy rightly gets maligned because I think it caused a lot of very, very weak thinking, particularly in areas of ethics. But I think Foucault, for me, stands out as a very, very brilliant and original thinker, and I find him hugely thought-provoking. And his lectures cover every subject you can think of. So highly, highly recommend those. And on a more mundane level, I've been reading Tony Atkinson's book on inequality, which is absolutely superb. And I think it's just called Inequality, and it's brilliant. It's brilliant if you just want the facts.
Atkinson's, okay.
Yeah.
For those people who are taking up the discipline new or have gone through, say, college education, and they're thinking of maybe branching out into certain specific areas, maybe like the hedge fund industry that you're in, would you have any advice for any of those people who are looking to make a decision on their next career move?
Well, I would tend to advise not to go into finance. I think probably way too many people go into finance. And I worry there's a kind of a Dutch disease. The Dutch disease is the old idea that, when you have high commodity prices, all the resources in the economy go into commodities, and other parts of the economy suffer. I think there's probably too many people suffer from the allure of entering the finance industry. But if you're interested in hedge funds, read about them. So I would read some Soros, and read the books by Drobny, which are superb. There's the House of Money. There's a couple of excellent books that written by Drobny, that's Drobny. I don't know if you've come across them.
No, I haven't actually.
Yeah, they're well worth reading. And Steve Drobny, who knows as much about the hedge fund industry probably as anybody out there. So I would highly recommend reading. There's a couple of books that Steve Drobny has written, which I think are excellent. And I'd read Soros and see if it interests you. And if you think it's interesting, you never know.
Do you know what is a good book, actually? I haven't read it in quite a few years, is Reminiscence of a Stockbroker, I think it's called, or Reminiscence of a Stock Trader. It has that kind of 1920s period. It's a true story, based on a true story. You can see that, you can experience all the highs and the lows, and eventually a fatality, a self-inflicted wound by the protagonist. I forget his name, after losing all his money. And to be honest, it is a great read. And then how it affected the children as adults being brought up in such an environment. Obviously, it's a story that is made. It's a factual story that allows itself to read well in a book. And I'm surprised it's actually not made into a film.
That's a good point. It would be a fun film for sure.
A great book. Eric?
Yeah. No, I was just going to say as well, the other classic, of course, The Great Crash.
Okay.
By Galbraith, which is always worth a read. But I think if you're interested in hedge funds, the Steve Propney books are superb. It's a bit like the Market Wizards books that you've referred to. You often have to work to find there's a little nugget somewhere in there.
Yes.
So there can be, you might have to get through quite a bit that doesn't mean very much, but then you'll find a little nugget that's really interesting.
I like some of the philosophy books though that are linked in with trading and finance. I think it's important, even with a book that has a chapter in that. I think it is a very good book where they actually include philosophy and also risk management. I think Victor Niederhoffer has some. I think where there's some philosophy in there, and I think people need to understand. And you've alluded to it in this episode, and in the previous one, we were talking about a lot of the behavioural heuristics that we as humans undergo, and we want to be aware of those so that we don't fall into a pretense that markets are as they are because of facts and parameters, but and ignore the possibility that we have inflated prices because of our human elements, just like causing an overreaction on the upside or the downside. As you mentioned with cryptocurrencies.
Have you read the little book Beats the Market?
Yes, a little blue book, a royal blue. Yeah, I read that years ago, and I also like the Turtle Trader books actually. But that's a nice little book.
Yeah, I would say to anyone thinking of venturing into investing in the stock market, read that book.
Yeah, there's a couple of those type of books in the series, but that one there, the little book that beats the market, is a nice little read. Very short book, small book.
It is. That's right. It doesn't take too long either.
No. Eric, look, I really appreciate the conversation coming on a second time.
Absolute pleasure.
And it was
my pleasure.
Nice to hear that, and the coffee and the coffee shop in the background. I almost felt a part of the scene. If I had a coffee here now, I'd be 100%.
Well, I hope it wasn't too noisy.
Not at all. And again, thanks very much for coming on the podcast for the second time. And people can check out philosophyofmoney.net to read more and find out a lot more about you, Eric, and your new book, Money. And just as a final note, I'd like to say you are an economic rock star, and thanks very much for coming on the show.
Frank, thanks very much. Thanks a million. Take care of yourself.
All the best. Soon. Thank you. See you later.
All the best, man.
Bye.
See ya. Bye.
Economic Rockstar is a free podcast that does not exclude anyone from listening as long as they have a device to listen, download or stream. I have many listeners from all parts of the world, and I truly am pleased to know that the Economic Rockstar podcast unites all of you through the common theme of economics. I strive to commit to releasing an episode each week and aim to develop Economic Rockstar into much more than just a podcast. Patreon is a platform that gives you, the listener of the Economic Rockstar podcast, the opportunity to express your appreciation of the show by committing a financial reward for as little as $1 a month. Patreon allows me, the creator of the Economic Rockstar podcast, to be rewarded and paid by you so I can continue with the running costs of the show and to reinvest and expand the podcast into other platforms or mediums in the future. To find out more on how you can help the Economic Rockstar podcast and have your name added to the supporters list on my website, please check out my Patreon page at patreon.com/Economic Rockstar or visit the supporters page on the Economic Rockstar website. If you enjoyed this podcast, why not leave some feedback or comments on the show notes page on economicrockstar.com, where you can also sign up and be a member of the Economic Rockstar community. If you're listening to this episode on iTunes or Stitcher Radio, I would love to have some feedback and for you to leave an honest rating and review, as this will help with the rankings of the show so that more people can find it. If you're listening on the website economicrockstar.com, make sure you check out the back catalogue of all previous episodes and interviews with some amazing professors and authors at economicrockstar.com/podcasts. Thanks for listening, and I really appreciate your loyal support. I know how much you love audio, so why not get a free audiobook with Economic Rockstar today? I've teamed up with audiobooks.com to bring you this amazing offer. Visit audiobooks.com/rockstar to download your free audiobook now.